Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Let's look at Twitter, see what people are talking about, see what news people are sharing. I'll give you my financial opinions as we go along, and we're going to dive right into it. If you want to follow me on Twitter, you can follow me at finding_finance. And if you want to join our community, you can join us at finding-value.com, where we talk more about individual companies and the strategies that we're deploying. We do have a 50% discount going on. The coupon code is called September. So coming on in, we've got Grady here. It says the U.S. Industrial Metals Index moved very strongly after I called the bull market start and blue false breakout back in April of 2020. Also posted on the breakout and back test. So this is industrial metals. A lot of the charts that we're looking at are very similar to iron ore, copper, all of those types of metals. A lot of the stuff that we're looking at in terms of diversified mining companies can also fall in this. And a lot of the dry bulk shippers are also tied to industrial metals and have a lot of the charts look very similar to this one here. This is the lead-in pattern. It's also forming a falling wedge in some companies. We can see that the stochastics on the bottom are basically double bottomed and are moving upward with higher lows and higher highs. And we could see a very big move, which would be, in my opinion, wave 3 of this move. So the U.S. industrial metals do look good. They do possess a very good technical chart pattern. And I do think that good things are coming ahead of us in the U.S. industrial metals. There's also other metals that we can look at, stuff like aluminum, nickel, and all those types of metals. Another one from Grady says uranium's just getting started, even though URNM has moved 580% in its baby bull move up from the 2020 low. What he has here is URA versus SPUT, is what they call it. And we've got basically a shoulder head shoulder pattern. He's got an inverted shoulder head shoulder pattern and a bowl shape where this ratio could go way, way higher out in the future. He says this chart shows that uranium miners have not yet even begun to outperform the uranium price, which is what makes a bull. A very stylish and bullish chart with this massive inverted shoulder head shoulder that we've got going on. So uranium miners are looking very good and they are very cheap. Oil prices. I've got Dow Jones to oil price, last bull market versus this current bull market. Let's see what they look like. This is the current bull market, a ratio that went off the charts for Dow Jones exceeding crude oil. Crude oil is coming back down. It's outperforming Dow Jones. We came back into this orange circle and are starting to head back lower. Looking at last bull market, we did something very similar. We came back down from a very cheap state, came back, we redid this is a retest move of the breakout lower, and then we compressed all the way back down. Now, from this circle, it took about 6 years to get to the top. If we look back, if you add 6 years, well, that puts us late 2020s, 2028, 2029, something on the lines of that. So we could have a good long bull market still ahead of us where crude oil vastly outperforms the Dow Jones Industrial Average. I looked at delinquency rates. They're holding very steady. This is the delinquency rates, or I'll just look at it here. That's super low, and they really haven't bounced off that bottom here. So they're incredibly low. They haven't bounced off the bottom. And right now, they're holding steady at a very low level. John Quates with uranium, he says, the spot uranium market is incredibly tight. In the event a buyer was to show up looking for 1 million pounds, the order probably takes 3 to 4 weeks to fill, and the gaps, the price up $10 a pound. That's what Cantor Fitzgerald said. And guys, that's 1 million pounds. So they're saying the market is super tight. It says, beware, according to Cantor's report, SPUT meetings, the uranium RFPs are coming. 4 to 5 different utilities expect to be looking for 5 million pounds each. Not a small ask in a market that looks very tight. Price discovery is incoming. So we've got a very tight price over in uranium, and looking back up here, we've got the uranium equities that are incredibly cheap. Very good setup here for uranium equities, undoubtedly. Even as home sales volume remains very low, home prices are holding steady. Available inventory of unsold single-family homes inched up just a hair this week to 509,000. That's 7% fewer than last year at this time. Last year, the 150 basis point move in rates caused inventory to surge through October. There's no sign of any surge in listings this year. So we've got a nice, steady inventory level of total inventory of homes. Transaction volume remains very low, only 54,000 new contracts this week, 14% fewer than last year. Labor Day is always slower, but in 2021, during the pandemic frenzy, we were seeing 80 to 90,000 contracts each week. So a little bit slow down there. Price reductions actually ticked lower this week. That's probably a sign of more withdrawals from the market, but it's also a sign that the market is not deteriorating from here. So we're not really increasing in price reductions. We've actually decreased slightly. Home prices are holding about 1% year-over-year gains across most measures. Median price of single-family homes are $445,000, roughly speaking. Median price of homes pending contract is $379,900. That's 1% higher than last year at this time. Last September, 150 basis point move in mortgage rates adjusted prices down. If we see an 8 handle this year, we could repeat that. An 8 handle is 8% mortgage rate. And that's what we've got for the housing market update there. COMEX silver inventory down 1.22 million ounces and registered stocks down 1.62 million ounces. Big buyers are stepping in and scooping up those silver ounces. This is First Majestic. They say, why silver is one of the most important elements on Earth. Silver supply constraints and a looming crisis. Silver demand is growing faster than supply. Limited organic growth, project delays, and disruptions have held back supply. Here's your total supply, and there's your total demand, far exceeding the total supply, putting silver into a large deficit. That deficit will first eat through inventories, which we're seeing here in COMEX silver inventories getting eaten up. Then the price starts to move. We're very close to what I think will be a very big price move in silver, platinum, and all these other metals. Eric Nuttall, global oil inventories now at their lowest levels since Kepler data began. And we believe we'll end 23-24 at 378 million to 750 million barrel deficit relative to the 2017-19 baseline average. This would strongly suggest a higher oil price. Yet, the current price many stocks trade at, 15% plus free cash flow yields, we remain bullish. So this is your total global oil held in inventory, onshore oil and on water. The forecast is a big move to the downside, sucking up or soaking up all the inventory in the world. Global observable oil inventory of everything, basically, and there's your forecast of the draws that are coming over 2023 and 2024. Prices are going to have to balance this thing out, and there's the big draws looking at it from over here. Coming on back. Grady, here's yet another chart showing that the second inflationary wave is about to start. Commodities, hard assets has once again broken out big time versus U.S. stock market financial assets since the commodities bear market low. We have a falling wedge that we've broken to the upside. This is your CRB, commodities to the S&P 500. I also show this on the daily update. Looks like other people are also seeing this. He says when the chart moves up, commodities outperform U.S. stock market and vice versa. We've got high rates are not a problem for households. Despite high debt levels and high rates, actual interest expense to households is still near multi-decade lows. And it cuts it off this page. I've got this moved over, but this very low here. And right now, household debt and the service payments of those debt is not at historically high levels. It's still very low. I've got here natural gas is one of the cheapest commodities on a ratio basis right now. I took the last bull market and overlaid it on the recent price action since 2020. I didn't adjust it a single bit. It looks very similar. So we can see how this looks. This is what I grabbed and I overlaid it on the data over here. And you can see it's basically almost the same exact pattern that's playing out today. A lot more natural gas upside, I think, is out there. I've got C&E correlation here, crude oil to gold ratio at the top, ExxonMobil below it. There are a lot more leveraged oil companies to play this outperformance with. Here's your kind of move higher with crude oil outperforming gold, and you can see the outperformance of ExxonMobil. You can see it peaked here, and then you can see a peak in ExxonMobil before this came on back. We did our consolidation. We've broken out of that consolidation, and Exxon has been just killing it for a large oil company. There's the outperformance on the right here, just killing it on the right there with the breakout of crude oil versus gold. Oops, looks like we popped back out here real quick. 1 second. What do you think will outperform? Small speculative uranium companies or cheap cash flow oil exploration and production companies? Put that in the comments section, what you think is going to outperform. Put either uranium or oil exploration. Let me know what your opinions are. Uranium's about to basically outperform everything. I posted that. Uranium versus nat gas, Dow Jones, platinum, and even palladium. They're all basically bottoming and coming back up in every single one of these. I think uranium does look very good for massive outperformance. It's also outperforming silver, the S&P 500, gold, and copper. It is set up to outperform absolutely everything. It doesn't mean that I'm going to put all my money in uranium. I know that these companies are speculative, but I have put a good chunk of money in it in case this were to play out. And it's enough in there that it would make a difference in my life. That's what I'll say. Looking at the stock market in terms of oil prices. Okay, I already posted that one. Again, Dow Jones versus crude oil, which I forgot about posting. I don't think people figured this out, but about what is about to happen in the energy markets. This is uranium versus gold. It is starting to turn up. It looks fantastic. I also have, and that's what this is here, I also have crude oil versus gold, which I already talked about. Both of these are going to outperform gold, which means the energy complex is going to absolutely put a waxing here. We could see interest rates move up further because of the outperformance and the inflation that we could see in crude oil and, well, mainly crude oil. This is a red line, every ship owner's wet dream via Clarkson's. This is your liquefied natural gas, and things are just ripping to the upside here, guys. So liquefied natural gas carriers could do very well coming up here with the increased pricing per day. Unless it's a secular bust, energy outperforms the market right after a pause, and then just for a bit when the Fed starts to cut. But by then, you're on borrowed time. And when you look, you can see that the gold line is the price of oil. This is the Fed funds rate in the blue line and dash line. When it pauses, oil continues to go up. Oil goes up when rates go up. Then it pauses, the Fed pauses, and oil continues to go up even after it starts to go back down for a lot of these cases. So oil still has a long way to run if interest rates continue higher, the Fed funds rate. They even can continue higher when the Fed funds rate pauses, and it can still continue higher after the Fed funds rate gets the first or second cut. Then you got to get the heck out of there. At least historically, that's what it's showing. Time to get this coffee stain template out of the drawer again. Asset allocation for high nominal GDP world. If you look at it, the winners in the stagflationary 1970s, energy, value. And again, what do all those charts are telling us that we just went over? It says that energy is going to outperform. Totally agree. Everything's in lockstep alignment with the stagflationary environment. If you had $5 million in the bank, would you quit your job? Ah, man. Well, number one, I wouldn't have $5 million in the bank. I would have a lot more dollars in companies that paid high dividends. And yes, I would quit my job because the dividend flows would be many hundreds of thousands of dollars if I had $5 million to play with that were cash or that cash that I could use to invest. Understanding where we are in the real estate. Okay, so that's what I did last one. We'll end it there, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Obviously, we still have that discount, 50% discount if you'd like to join. It's 50% off. September's the coupon code. But everything's still intact, guys. It looks like everything that we're looking at in terms of the information that I'm gathering from Twitter, it's all in, it's all positive information for commodities to continue its outperformance. Energy probably being the biggest winner of all of them. So that's what I've got for today. We'll catch you guys later. This is Finding Value.